Welcome to the Deep Dive. And today, we're kicking things off with a fact that really makes you pause. In July 2025, a company hit an astounding $4 trillion market valuation. I mean, leapfrogging tech giants we once thought were, unassailable. Apple, Microsoft.
Right. It's kind of mind-boggling when you think about it.
It really is. And this isn't just some financial number, is it? It signals something much deeper. A fundamental shift in, global economic priorities. It tells us what really drives value today.
What's truly fascinating here, I think, is that it's not just about a company making a ton of money. It's about how they've strategically positioned themselves right at the heart of what many are calling the new industrial revolution. Artificial intelligence.
That's right. So today our deep dive is all about NVIDIA, the pivotal force driving this AI revolution. We're going to unpack exactly how they reached this, frankly, unprecedented valuation.
And what it means.
And more importantly, what that means for the future of technology and, our entire world. Our mission here is pretty straightforward. We've taken a stack of information, financials, industry analysis, a lot, and we're distilling the key nuggets for you.
Kind of the highlights.
Exactly. Think of this as your shortcut to understanding NVIDIA's dominance, maybe some surprising facts behind that success, and the really critical questions shaping its path forward. We'll get into its picks and shovels role in this AI gold rush.
That's a good analogy.
And uncover how its unique full-stack ecosystem has become its greatest strength. That's moat, really. So let's dig in.
Okay. Well, NVIDIA's journey is pretty remarkable. It starts, rather humbly, founded back in April 1993.
93.
And their initial focus was just on graphics accelerators for the PC gaming market, which was just emerging then.
Right. It was pretty niche at the time.
Yeah.
But they obviously had some vision, some early breakthroughs too, didn't they?
They did. The IPO was in 1999 at $12 a share.
$12. And now look at it. If you adjust for splits, no dividends, that one share is worth, over $73,000 today.
It's astronomical. And later that same year, 1999, they introduced the GeForce 256 era, boldly called it the industry's first GPU.
Which wasn't just about making games look better, right? That was laying the groundwork.
Exactly. Crucial groundwork for parallel processing.
Yeah.
That became their future, even if they didn't fully realize the extent of it back then.
Okay, so parallel processing is key. But the real game changer, everyone points to CUDA.
Right. Yes. CUDA. That was 2006. Compute Unified Device Architecture. This was the monumental leap.
Why was it so significant?
Because it let developers use GPUs for, general purpose computing, not just graphics anymore.
Good.
It basically unlocked this massive parallel processing power for things like high-performance computing and, critically, for AI.
So they were already thinking beyond graphics way back in 2006.
The potential was unlocked then. It was, honestly, strategic foresight that paid off beyond anyone's wildest dreams at the time.
And they really leaned into that, didn't they? Anticipating the AI wave.
Oh, absolutely. The pivot became crystal clear, I'd say. April 5th, 2016, they unveiled the NVIDIA DGX-1.
The deep learning supercomputer.
They marketed as the world's first, yeah. And this wasn't them reacting to a market demand. They were creating the market for AI infrastructure.
Proactive.
Yeah.
Positioning themselves for dominance years down the line.
Precisely. They saw where things were heading and built the tools needed to get there.
And, it certainly paid off. You mentioned the ChatGPT moment in late 2022.
Right. Suddenly, everyone was talking about generative AI, and that just fueled NVIDIA's climb, rocketed past $1 trillion by May 2023.
Their shares became the poster children for the AI boom.
Absolutely. Everyone wanted a piece of the action, and NVIDIA was the action.
Which brings us to that peak. July 10th, 2025. Briefly surpasses $4 trillion, world's most valuable company.
Just incredible, driven by huge anticipation for the Blackwell platform launch and this massive backlog of data center orders already piling up.
The growth numbers are just hard to wrap your head around. Since that 99 IPO, it's insane. But even just the last 5 years, a growth of plus 1,491%. Compare that to the S&P 500, which was up, 96.5%?
It's not even comparable.
Not even close. And putting that $4 trillion cap in perspective, Microsoft at $3.7 trillion, Apple $3.15 trillion in July 25. It's a complete reordering.
It really is. The company providing the fundamental AI infrastructure is now worth more than the giants building on top of it.
It signals that the picks and shovels are, for now at least, proving more valuable than the gold miners themselves.
Which leads us right into the core of their current success. Data centers. That's the engine now.
Right. They are the picks and shovels provider for this AI gold rush.
Equipping pretty much everyone who wants to dig for AI gold, so to speak.
So who's doing all the buying? Who needs all these picks and shovels?
Primarily, it's the hyperscalers, your huge cloud providers, Microsoft Azure, Amazon Web Services, Google Cloud. They're aggressively re-architecting their massive data centers, turning them into AI-accelerated facilities, or AI factories, as they're sometimes called.
And this investment is so huge, people call it the NVIDIA tax.
Yeah, that's the colloquial term you hear sometimes, because it's almost impossible to build these state-of-the-art AI facilities without NVIDIA's chips. They have such a dominant position.
And the scale of this investment is enormous, right?
Immense. Global data center spending projected to go from $400 billion in 2024 to maybe $1 trillion by 2028.
What, $1 trillion? Wow.
And NVIDIA is right at the heart of that explosion. Just look at their fiscal year 2025 numbers. Total revenue, a record $130.5 billion.
Okay.
But the data center segment, $115.2 billion. That's roughly 88% of their total revenue.
88%.
Up 142% year over year.
Exactly. It just hammers home the reorientation of the company.
Yeah, because gaming, which used to be their main thing.
Now just $11.4 billion, about 8.7%. And automotive is even smaller, $1.7 billion, just over 1%.
It's crystal clear where their focus and future lie. It is. And it reflects that near monopoly they hold in AI chips, consistently estimated between 80% and 92% of the AI accelerator market.
Their hardware is obviously top-notch. The H100 chip became the standard.
The H100, based on the Hopper architecture from 2022, yeah, it set the benchmark. But now the next leap is Blackwell, expected Q4 2024.
Blackwell. What's the big deal there? I hear staggering numbers.
The specs are pretty wild. 208 billion transistors, 192 GB of high bandwidth memory. But it's not just the raw numbers.
No.
It's what those specs enable. Handling much larger, more complex AI models, it basically unlocks the next generation of AI possibilities, things that just weren't feasible before.
So better performance too.
Significantly. Like 2.2 times better for training AI models and 4 times better for running them for inference compared to the H100.
Okay, so the hardware is incredible, but you mentioned their economic moat earlier. You said it's not just the chips, it's CUDA. Can you unpack that?
Right. CUDA is... well, it's the software side, it's the programming platform, the ecosystem, and it's considered the gold standard for developing AI applications.
How does that create a moat?
It creates this virtuous cycle and powerful developer lock-in. Basically, millions of developers know CUDA, they build tools on CUDA, research is done using CUDA.
So everyone's already using it.
Exactly, which means there's huge demand for NVIDIA hardware that runs CU efficiently. This success then lets NVIDIA invest more into CU, making it even better, which attracts more developers. You see the cycle.
And makes it hard to switch.
Notoriously difficult. Migrating complex AI software stacks built for CUDA to different hardware, like AMD's or Intel's, often requires rewriting huge amounts of code. It's a massive undertaking.
So that's the secret weapon, the software lock-in. But what about competitors? AMD, Intel, they're making noise. Are they a real threat?
They're definitely making progress, and it's important. AMD's Instinct MI300X chip looks good on paper, lots of memory, high bandwidth. And they have ROCm, their open source software platform, positioned against CUDA.
Open source could be appealing.
It could. And Intel's Gaudi 3 chips are focused on being cost-effective, even beating the H100 on some specific inference tasks.
So it's not game over for competition.
Not at all. But the crucial point is, it's not just a hardware spec battle, it's an ecosystem contest.
Ah, back to the software.
Right. NVIDIA has highly optimized software libraries like TensorT LLM. There are tests showing this software can basically double the performance of AMD's MI300X when running certain AI models like Llama 2.
Even on the competitor's hardware.
Yeah. It shows how powerful NVIDIA's optimized software stack is. It remains this formidable barrier.
That really drives home the ecosystem point. Okay, let's look at the real world. How does this play out with major players? OpenAI, for instance, how reliant are they?
Immensely reliant. Look at Oracle, who's a key cloud partner for OpenAI. They reportedly placed a massive $40 billion order.
$40 billion. For what?
For about 400,000 NVIDIA GB200 AI chips, specifically for a new data center to power OpenAI's next-generation models.
So NVIDIA is basically powering the bleeding edge of AI development there.
It certainly seems that way. They're indispensable for training these huge cutting-edge models.
What about Tesla? Their relationship seems more complex.
It's a good example of dynamic selective reliance. Tesla did use NVIDIA chips, the Drive PX2, back in 2016 for their early autonomous driving work.
Right.
But then in 2019, they made a strategic shift to their own custom-designed FSD chips for the core self-driving functions.
So they moved away from NVIDIA for that specific task.
For that task, yes. But more recently, there were reports of Elon Musk redirecting a batch of H100 GPU's powerful general AI chips that were originally meant for Tesla over to his other ventures, X and XAI.
Why?
The stated reason was that Tesla's own infrastructure wasn't quite ready to utilize them effectively yet.
Interesting. So it shows that even companies developing custom chips still rely on NVIDIA for broader AI compute power or different parts of their infrastructure. It's not always an either.
Exactly. It's selective reliance, not necessarily outright replacement across the board.
Okay, let's shift gears a bit. Let's talk money. Because NVIDIA's financial performance is just explosive, a real profit engine.
It really is. The growth in their net income, their profit, shows incredible operating leverage. They scale incredibly well.
Give us the numbers.
Okay, fiscal year 2023, net income was $4.368 billion, respectable. FY 2024, it soared to $29.76 billion.
Huge jump.
And then FY 2025, it rocketed to $72.88 billion on a GAAP basis.
$72 billion. That efficiency is incredible. Converting revenue to profit at that scale.
It truly is. It showcases how profitable their dominance is.
Now, valuation metrics. The PE ratio, the price to earnings, got pretty high, right? Peaked at over 138 in April 2023.
It did, yeah. There was a lot of hype baked in then. But by July 2025, it had normalized somewhat, down to about 52.5. And the forecast for FY 2026 is around 33.4.
What does that normalization tell us? Is the crazy growth phase over?
Not necessarily slowing growth, but maybe the market catching up and pricing things in more realistically. Moving from, let's say, speculative excitement to more grounded expectations based on the phenomenal results.
Okay.
What's really interesting, though, is the PEG ratio, price earnings to growth. As of July 9, 2025, it was 0.63.
And that's low.
Very low compared to the semiconductor industry average of about 2.74. A peg below 1 generally suggests the market feels the company's growth prospects justify or even outweigh its current share price and PE ratio.
So even with a high PE, the growth story is still seen as compelling.
That's what the peg ratio suggests, yes. Investors still see significant growth ahead.
And their cash generation,
Yeah.
free cash flow, that's jumped massively too.
Phenomenal. From about $3.8 billion in FY 2023 to nearly $61 billion, 60.853B in FY 2025.
$61 billion in free cash. That gives them enormous flexibility.
Absolutely. It underscores their ability to just print cash from operations. And that cash is crucial.
For reinvestment.
Exactly. Maintaining that technological lead costs money. Their R&D spending hit almost $13 billion, 12.914B in FY 2025.
Up nearly 50% from the year before.
Right. That sustained, heavy investment in R&D is what fuels their innovation engine and keeps them ahead. It's vital.
Okay, so incredible success, a strong moat,
Oh.
but there must be risks, storms on the horizon. Let's talk geopolitics, competition. Those China export bans must hurt.
They've had a definite financial impact, yes. NVIDIA took a $4.5 billion charge in Q1 FY25 inventory write-downs, lost orders.
Ouch.
And they anticipated losing another $8 billion in sales in Q2 FY25. The total hit could be up to $15 billion in lost revenue because of these U.S. restrictions.
And Jensen, the CEO, basically said the China market is closed to them now.
He was very direct. So the $50 billion AI chip market in China is effectively closed to U.S. industry. And specifically, the ban on their H20 chip ended our Hopper data center business in China.
So a significant chunk of the potential market is just gone.
For their most advanced chips, yes.
And the unintended consequence here seems to be boosting China's own chip makers, like Huawei.
That's exactly what appears to be happening. When you restrict access to the top-tier tech, it forces, or at least accelerates, domestic development. Huawei's Ascend AI chips are the prime example.
How good are they?
They're ramping up production aggressively. The Ascend 910C can reportedly deliver maybe 60% of the H100's inference performance. It's not quite there yet, but it's progress. And it fosters this more fragmented global AI chip market where China is pushing hard for self-sufficiency.
Okay, another threat. Their own customers building custom chips. Google, Amazon, OpenAI. That sounds like a big deal long-term.
It absolutely is a significant long-term threat. These tech giants operate at such a massive scale that designing their own chips makes sense.
Like Google's TPUs.
Right, their tensor processing units. Reports suggest they can run AI workloads at maybe just 20% of the cost of buying NVIDIA hardware.
20%, that's a huge saving.
It is. And Amazon has Trainium, OpenAI is planning its own chip by 2026, Microsoft, Meta, they're all working on custom silicon too.
Why? Just cost.
Cost is a big driver, yes,
Right.
reducing reliance on NVIDIA, but also optimization tailoring chips specifically for their unique workloads in data centers. It could definitely erode NVIDIA's market share over time, especially for certain tasks.
Beyond competition, what about their supply chain? They rely heavily on TSMC in Taiwan, right?
Very heavily. Especially for their cutting-edge GPUs like Blackwell, TSIC makes the most advanced chips.
And that creates risk.
Huge geopolitical and operational fragility. TSMC is based in Taiwan. Any disruption there, political instability, and natural disaster could severely impact NVIDIA's ability to produce chips and meet global demand. It's a major concentration risk.
And then there are things like U.S. tariffs.
Yes, broader trade policies impact them too. They faced $5.5 billion in costs due to those tightened export rules on the H20 chips for China. That forced them to raise prices on some GPUs by up to 15%.
So geopolitics directly hits their bottom line in pricing.
It illustrates how chip manufacturing and trade have become sort of weaponized, creating barriers and adding costs.
Okay, let's switch gears again. A really big topic now. Sustainability, the AI energy crisis. This seems like a huge challenge.
It's massive. The electricity consumption of these AI data centers is just soaring.
How much are we talking?
Projections are pretty startling. Deloitte, the IEA, they think global data center electricity use could double by 2030, reaching maybe 4% of all global electricity.
5%.
And AI-specific data centers could quadruple their demand by then. MIT found power consumption in North American data centers doubled just between late 2022 and late 2023.
Doubled in a year. Wow. And it's not just power, it's water too.
Huge amounts of water. Roughly 2 liters of water for every kilowatt hour of energy used, mainly for cooling.
That's staggering. So is NVIDIA just fueling this crisis, or are they trying to address it? What are their solutions?
They are definitely aware of it and promoting solutions. Their main argument is that their accelerated computing approach is actually far more energy efficient than traditional CPU-based computing.
Much more efficient.
They claim like a 20x improvement overall.
Right.
And the newer Blackwell Ultra GPUs, they're estimated to be over 50 times more energy efficient, specifically for running large language models.
Okay, efficiency gains are key. What else? Cooling?
Yes, they're pushing liquid cooling hard. Their A100 liquid-cooled GPU, for example, helps data centers achieve a much better power usage effectiveness, PUE.
PUE.
Lower is better. It measures how much energy goes to the computers versus cooling and other overhead. Liquid cooling gets around 1.15 PUE versus maybe 1.6 for typical air cooling.
That's a big difference.
It is. And their big GB200 NVL72 rack system, they claim it's 300 times more water efficient too, so they are trying to position themselves as part of the efficiency solution.
Sounds promising on the tech side, but they've still faced criticism on the broader ESG front. Environmental, social, governance.
Yes, despite having a relatively decent low ESG risk rating from Sustainalytics, concerns persist. There's definitely scrutiny.
What kind of things?
Well, there were reports about them allegedly scraping a human lifetime worth of videos from places like YouTube and Netflix to train AI models. That raises big questions about copyright and data ethics.
Right. Any other controversies?
There have been past issues. Misleading specs on a gaming card, the GTX 970. A $5.5 million SEC fine in 2022 for not properly disclosing how much revenue came from crypto mining versus gaming back when that was booming.
Okay, so some disclosure issues. What about environmental footprint directly?
Their own reports show greenhouse gas emissions over 2.1 million metric tons of CO2 equivalent annually, and significant water use, almost 800,000 cubic meters a year, with a lot of that coming from water-stressed regions.
And ethical use.
Concerns have been raised about their tech potentially being used by surveillance companies implicated in human rights issues. These are all complex challenges for a company at their scale.
So how are they responding? What are their commitments on ESG?
They have stated commitments. They say they achieved 100% renewable electricity for their global offices and data centers in fiscal year 2025.
That's significant.
Yes. And they have targets to reduce their direct emissions, Scope 1 and 2, by 50% by FY 2030, and also cut the emissions intensity, Scope 3, from their sold GPUs. They also highlight using AI for positive things, like conservation.
Okay, looking ahead now. What's next for NVIDIA? Their product pipeline seems incredibly aggressive.
Relentless is the word. It signals a clear strategy, a yearly release cadence for their crucial data center products. Keep the innovation cycle incredibly fast.
What's coming up?
Blackwell Ultra, the B300, is slated for late 2025 more high-bandwidth memory. Then the next major leap is the Vera Rubin architecture.
Rubin, when's that?
Late 2026 for the first Rubin chips, the R100 GPU, maybe a new ARM processor called Vera CV100, then Rubin Ultra in late 2027.
And these are big jumps in performance and capability.
Huge jumps projected. We're talking massive memory increases, up to 1 terabyte of HBM4E memory on the Ultra. Performance potentially hitting 100 petaflops at certain precisions. It's about constantly pushing the boundaries.
And they're even looking beyond current AI into quantum computing.
Yeah, that's a fascinating long-term bet. They're opening the NVIDIA Accelerated Quantum Research Center, NVAQC, in Boston later in 2025.
What's the goal there?
To advance hybrid quantum algorithms combining classical supercomputers, like their GB200 systems, with quantum processors. They're using their CUDA software platform for this. It shows they want to be ready for the next computing paradigm shift, whenever it happens.
Positioning for the future. Okay, analysts are throwing around some huge numbers for NVIDIA's future valuation. $5 trillion.
We are seeing those predictions. Wedbush analysts suggested they could hit $5 trillion within 18 months or so. Other articles point to $5 trillion by 2028, tying it to that projected $1 trillion annual data center spend globally.
And some price targets are just way up there. Rosenblatt mentioning $2,000 a share.
Yeah, some analysts are incredibly bullish, projecting continued dominance and growth in the AI infrastructure market.
This kind of rapid rise, these huge valuations,
Yeah.
it inevitably leads to the bubble debate. Is this sustainable, or are we in an AI bubble reminiscent of .com?
It's the $1 million or maybe $1 trillion question, right? And there are arguments on both sides.
What's the argument for it being a bubble?
Well, the parallels are tempting. You see remarkable stock growth, incredibly high valuations, this sense of an AI premium being paid for related stocks, concerns about momentum being unsustainable, just like the .com craze.
Okay, sounds familiar, but what's the counter argument? Why might this not be a bubble like last time?
There are some key differences. Firstly, the demand isn't primarily fueled by speculative venture capital or debt like .com often was. It's driven by the real massive free cash flows of a handful of the world's biggest companies, the hyperscalers. They need this infrastructure.
Right, real companies spending real money.
Exactly. Secondly, those valuation metrics, while high, aren't quite as stratospheric as the peak .com levels. NVIDIA's forward PE forecast of 33 is way lower than, say, Cisco's 150 back then.
Okay, more grounded, relatively speaking.
And maybe most importantly, AI isn't just one application. It's seen as a foundational, general-purpose technology transforming every industry. The demand feels much less likely to just evaporate because it's becoming fundamental to business.
So, while the growth is startling, the underlying drivers might be much more solid this time around.
That's the argument against it being a classic bubble, yes. The demand seems far more durable.
Okay, but even if it's not a bubble about to pop, there are still significant long-term threats to consider.
Absolutely. Two big ones stand out. First, AI commoditization. As those custom chips from Google, Amazon, etc. get better, and as open source software alternatives to CEA potentially mature, could that erode NVIDIA's pricing power? Could it weaken that crucial software moat over time?
Right, if alternatives become good enough and cheaper.
Precisely. The second big threat is regulatory crackdowns.
On AI itself.
Yes, we're seeing increasing scrutiny globally. Things like that DeepSeek AI scandal in 2025, legislation like the EU's Comprehensive AI Act coming into effect in 2026. It's creating a regulatory arms race.
What does it mean for companies like NVIDIA?
It means the sort of innovation at all costs era might be ending. Compliance becomes crucial, potentially a competitive advantage. But it could also slow things down or fragment the global AI market further if regulations differ wildly between regions.
Lots to navigate there. So let's try and sum this up. NVIDIA's journey to $4 trillion is, well, remarkable. They've undeniably cemented themselves as the core technology provider for this AI revolution.
The ultimate picks and shovels play for the AI gold rush, really driven by those cutting-edge GPUs and, crucially, that CUA software ecosystem.
But as we wrap up this deep dive, there are some big lingering questions, aren't there? Questions that will shape not just NVIDIA, but the whole tech landscape.
Definitely. First off, given how deeply entrenched CUDA is, that developer lock-in, can competitors really close the gap? Or will it always be more about the whole ecosystem, not just chip versus chip?
That's a huge one. And second, sustainability. Is this exponential AI growth actually sustainable long-term? Considering the colossal energy and water demands, those supply chain pressures we talked about, can we keep this up?
A critical question for everyone. And finally, those custom chips. Will hyperscalers building their own silicon fundamentally fragment the market? Or can NVIDIA adapt its strategy, maybe shift its business model somehow to stay indispensable even to them?
These are the questions we'll be watching. So as AI keeps reshaping everything, here's a final thought for you, the listener. How much of our technologically advanced future will ultimately remain built on NVIDIA? And what does that concentration of power in one company truly imply for innovation, for access, and for responsibility across the globe?